Billionaire investor Philippe Laffont recently made a bold prediction, saying that 1,000 AI workers are coming and that the next $10 trillion giant company is emerging. In a CNBC interview, the Coatue management founder shared his latest views on artificial intelligence, Agentic AI, Bitcoin, chip stocks, SpaceX, and where he believes the biggest opportunities of the next decade could emerge. First, I'll show you the interview clip uninterrupted. Then I'll break down exactly what Laffont is saying, share my own reaction and analysis, and explain why his comments could have major implications for investors. Finally, I'll reveal 3 under-the-radar AI stocks that could be worth buying right now. Let's hear what Philippe Laffont has to say.
Talk a little bit about Bitcoin. Do you still wake up and say, why am I so stupid? And wake up at 3 a.m. in the morning, why didn't I buy more? Or
I always wake up at 3 a.m. And I always feel stupid about something.
Yeah.
But now it's not Bitcoin anymore.
It's not.
I don't know what to think about Bitcoin anymore. The one thing I was wondering with Bitcoin is there was a time when there were very few IPOs. Part of it is I think the public markets are a little bit broken with so many index funds and stuff. Everybody thinks the same, thus nobody really wants, new IPOs. I wonder if Bitcoin was a little bit sort of the off-ramp for everybody that wants to have something a little bit more speculative.
Yeah.
Now that we have these big IPOs on one side, and then we have stablecoin on the other, and stablecoin involves the word stable. So if you really want to just put your money offshore, put your money in a new system, you can go through stablecoins. Frankly, stablecoins more or less are already paying interest. I don't think they really are, but there's schemes where you get these like rewards and stuff like that. So if you want just the stablecoin, you can. There's fabulous IPOs coming out. There's SpaceX, there's going to be some AI. And I just wonder, well, where is Bitcoin now? And the purpose of Bitcoin, and a little bit what you need to believe, is almost this maximalist view about Bitcoin. Like when I speak to people about Bitcoin, it's a bit like a cult. You're either in or you're not. So that's just my new thoughts on Bitcoin. So I'm a little bit more worried, and I would rather bet on, is space going to quadruple over the next 20 years? Or these intelligence models going to be, like if you think today the market cap of the world is 70 trillion, of the US, 60 to 70, let's say maybe it's 130, 140. In 10 years, it could be, let's say, 200 plus. Is there going to be a $10 trillion company in 10 to 15 years? I find that debate and trying to figure out which of those companies might be a $10 trillion company sort of easier for me than figuring out where's Bitcoin going to be in 10 years.
So what's the answer to that question? Is there going to be a $10
I think there is.
Company?
I think yes. I think like today, NVIDIA is what, 5, 4.5, 5? Let's say 4, keep it simple. And the market cap of the US is 60. And let's say the market cap of the world is 120. So a large company can represent 6 or 7% of the US and maybe 3, 4% of the world. So in the future, could a company be worth 5% of the world? No, that would be 10 trillion. In essence, if the world someday in 10 years or so gets to 200 trillion, and which one could it be? Could be one of the existing ones, could be one of the new ones, which is sort of fun because the Mag 7 is sort of changing in front of our eyes, right? It's really no longer quite the same. First, I think it's more like Mag 11, Mag 12. If you think that the Mag is every company over $1 trillion, so you've got 11 or 12, I think Berkshire, Eli Lilly, there's a couple non-tech ones, but you've got TSM, Broadcom, you've got a few others. I think in the future, there's a good chance that OpenAI and Anthropic could be there, SpaceX could be there, maybe there'll be another space asset, who knows, maybe Blue Origin or something like that could turn out to be a second very large company in space. So I find what's fun for me and what keeps me going is to imagine sort of this index of the future and who's going to be in that index of the future. And if you can do that and sort of stomach the daily volatility like today, then you should be able to do well.
You said 5 great ideas. We didn't get all 5, but I know you have maybe a future one right now in Agentic AI, and you've even referred to it as almost a Big Bang moment, right? Is that one of
I have found, like, in thinking about Anthropic in particular, and OpenAI is doing equally well. Sometimes Anthropic does a little bit better. Maybe like now, I'm convinced that at some point OpenAI will do a bit better. Then it will be Anthropic. To me, the two key questions on the models is one, there's this view that somehow models are going to be free, that you have these open source and this intelligence is going to be free. I don't think so. I think people are going to want to sort of do business with the best models in the world. And also you could have the best model that's expensive, but you could have the Anthropic model from 3 years ago that's like super cheap. So Anthropic could both be cheap and not. With respect to these models, all the stuff around agents and the ability to have thousands of people working for you, that sounds like one of the bigger ideas, at least in my investment career. This concept that you sort of go to bed at night, there's 1,000 people working for you, and you got all this work done and ready for you the next day. It's a new way of working. I'm having a hard time. I'm still like scribbling on a piece of paper, my notes and stuff like that. But I see people, even in our own office, the way they come up with new ideas and the productivity they get from AI. It's really there, and it's still moving quickly.
So, and you would participate in that the way that you are already.
I think through Anthropic, through OpenAI, and I also think, and it's a bit of a shame, like, why are these companies not public earlier? And why isn't it that retail and small investors can't get access to them earlier? And
I was going to ask you about that, because you still have some nice fees with but you've opened up. Why did you do that? You didn't need to bring in retail people to participate with your genius.
Correct. Our business has sort of been mostly an institutional business. Basically, there's laws that private companies, shorts, hedge funds, you have to be more or less a accredited or institutional investor.
Right.
Because there's more risk. And so with more risk, you're supposed to have more financial literacy. First of all, I find that offending. Why is it that we think that institutions are more financially literate, maybe than retail investors? I'm not sure that's true. I believe in the wisdom of the crowd. But there's things such as leverage and stuff. I think that's changing. I think the current administration is improving this. So for us, we started this new fund that basically allows us to offer publics and privates with some restrictions. And I do think that in the future, and this is one of the reasons why private markets are so big, private markets in debt became very big precisely because, in my mind, the public markets in debt, they were too dumb, too simple. Oh, if you're not AAA, I'm not lending to you. Mm-hmm. Great. People find an opportunity. Private market in tech is going to be the same. Hey, if the IPO and the world is dominated by these indices that all think the same and sort of have abdicated their intellectual property to others that create the weights for them, hey, well, then there's going to be a private market. Private market today is probably 5 or so trillion. Public markets are, let's say, 60. A private market in tech, still a big market.
So why? And off camera, I said, can I participate in one of these retail funds? And that's A. And B, will you lend me the money up front so I am able to participate?
The answer to the second show, I already tell you, is a definite no. We don't lend money to anybody. That's not our business.
Think if you would.
Especially you.
So Joe, if you were an investor, you wouldn't ask me all these tough questions.
Is this altruism, though, that do it? Or
No, not at all.
But you also get great 12.5%.
It's a great business opportunity for you. You get lower fees. You get longer dated capital. To me, the longer dated capital is very, very important because I'm trying to figure out the index of the future 10 years out. Yeah. How do you do that?
So
that's why.
You need the funds to
and at the end of the day, $1 of long dated capital might be worth $3 of that can leave in any given quarter.
Sure.
So from an economic viewpoint, that might actually even be the right bet to make.
The conversation begins with a light-hearted reference to Bitcoin, something Laffont has spoken about extensively in the past. The host jokingly asks whether he still wakes up at 3 in the morning regretting not buying more Bitcoin. Laffont laughs and admits that he still wakes up at 3 in the morning worrying about something. But interestingly, Bitcoin is no longer at the top of that list. That immediately caught my attention because this is a man who once openly talked about missing part of Bitcoin's rise. Yet now, instead of expressing excitement, he sounds uncertain, and I think that uncertainty is very important for investors to understand. Laffont explains that when Bitcoin first emerged, the investing landscape looked very different. There were fewer IPOs available to investors. Public markets were becoming increasingly dominated by index funds, and many investors looking for high-growth opportunities had fewer places to put their money. In that environment, Bitcoin became an attractive outlet for speculation. His argument is fascinating because he's essentially saying that Bitcoin may have benefited from a lack of alternatives. Investors wanted excitement, they wanted asymmetric upside, they wanted something beyond traditional stocks. Bitcoin filled that void. But now, according to Laffont, the world is changing. Today there are major IPOs coming to market, there are emerging opportunities in space exploration, there are groundbreaking developments in artificial intelligence, there are stablecoins offering entirely new financial systems. Suddenly investors have more options competing for their attention. This is where Laffont begins questioning Bitcoin's future role. He points out that stablecoins have become increasingly useful for people who want to move money outside traditional banking systems. Unlike Bitcoin, stablecoins are designed to maintain value stability. Some even offer reward structures that make them more appealing for practical financial use. His broader question is simple. If investors can access exciting IPOs, revolutionary AI companies, private technology giants, space exploration ventures, and alternative financial systems through stablecoins, then what unique role does Bitcoin ultimately play? That is not a criticism of Bitcoin itself. It is a challenge to the investment thesis, and personally I think this is one of the most interesting points he makes in the entire interview. Whether you agree with him or not, investors should constantly reassess their assumptions. Markets evolve. Competitive landscapes change. What looked like the most compelling opportunity 5 years ago may not necessarily remain the most compelling opportunity over the next 10 years. Laffont then says something that many Bitcoin enthusiasts probably won't love hearing. He suggests that believing in Bitcoin increasingly requires a more maximalist mindset. In his view, many Bitcoin supporters have become deeply committed to the asset in a way that resembles a belief system. He describes conversations with Bitcoin advocates as almost all-or-nothing discussions where people are either fully committed or completely unconvinced. Again, whether you agree or disagree, it is interesting to hear that perspective from someone who has spent decades evaluating investment opportunities across multiple market cycles. What's even more revealing is where he says he would rather place his bets. Instead of trying to predict where Bitcoin will trade 10 years from now, Laffont would rather focus on identifying future mega companies. Specifically, he wants to identify businesses that could eventually become $10 trillion enterprises. That idea sounds almost absurd at first. After all, a $10 trillion company would be more valuable than nearly every company in history combined. But Laffont walks through the math. He points out that today's largest companies already represent meaningful portions of total market capitalization. If global equity markets continue expanding over the next decade, then mathematically it becomes possible for a single company to reach valuations that seem unimaginable today. This is where his thought process becomes especially compelling. Instead of asking whether Bitcoin can rise another 5 or 10 times, he's asking which companies might dominate the future global economy. Which businesses will control intelligence? Which businesses will control transportation? Which businesses will control space? Which businesses will define the next era of productivity? Those are the questions keeping him engaged, and honestly, I find this framework incredibly useful. Rather than obsessing over short-term market fluctuations, Laffont is trying to visualize the future economic landscape and then position himself accordingly. He then discusses the famous Magnificent Seven stocks and suggests that even that concept may already be outdated. In his view, there are now more than 7 truly dominant companies. The trillion-dollar club continues expanding. Traditional technology leaders are being joined by semiconductor giants, healthcare innovators, and entirely new categories of businesses. What's particularly interesting is that he believes companies that aren't even publicly traded today could eventually join that elite group. He specifically mentions OpenAI and Anthropic as potential future trillion-dollar giants. He also points to SpaceX as a company with enormous long-term potential. That observation highlights one of the biggest frustrations facing ordinary investors today. Many of the world's most exciting companies remain private for longer periods of time. By the time they finally become publicly traded, much of the explosive growth has already occurred. Laffont clearly believes this trend is problematic because retail investors often miss out on the most lucrative stages of value creation. The conversation then shifts toward artificial intelligence, and this is where Laffont becomes noticeably more enthusiastic. In fact, I would argue that AI is the topic that truly energizes him throughout the interview. He focuses heavily on Anthropic and OpenAI, two companies that he views as leading the development of advanced intelligence models. One of the most important points he makes is that he disagrees with the popular belief that AI models will eventually become free commodities. Many people assume that open-source models will eliminate pricing power and make advanced AI available at little or no cost. Laffont doesn't buy that argument. He believes businesses and consumers will continue paying premiums for the best intelligence available. Just as people pay more for superior software, superior hardware, or superior services, he believes they will pay more for superior AI models. And frankly, I think he's probably right. Throughout history, the highest quality products tend to command pricing power. While lower-cost alternatives may exist, market leaders often continue capturing significant economic value. But then he introduces what may be the most important concept in the entire interview: Agentic AI. Laffont describes a future where intelligent AI agents perform meaningful work on behalf of individuals and businesses around the clock. His description is remarkably powerful. Imagine going to sleep at night while thousands of AI agents continue working for you. They conduct research, analyze information, write reports, solve problems, generate ideas, complete tasks. And when you wake up the next morning, all of that work has already been completed. To Laffont, this isn't just another technological advancement. It is a fundamentally new way of working. He even calls it one of the biggest ideas of his entire investment career. That statement carries significant weight when it comes from someone who has witnessed the rise of the internet, cloud computing, smartphones, social media, and modern artificial intelligence. What makes this even more interesting is that he admits he is still adapting to these tools himself. He jokes about continuing to write notes on paper, but he can clearly see how younger employees and colleagues are already using AI to enhance productivity and creativity. I actually appreciated that honesty. Too often people portray technological change as something that happens overnight. In reality, even highly sophisticated investors are learning and adapting in real time. Laffont sees the productivity gains firsthand, and what excites him most is that the technology still appears to be accelerating. The interview then moves into a topic that deserves much more attention from investors: access. Specifically, who gets access to high-growth investment opportunities? Laffont argues that the traditional distinction between institutional investors and retail investors may be outdated. Historically, private investments were largely reserved for accredited investors and institutions. Regulators assumed these investors possessed greater financial sophistication and could better handle risk. Laffont openly challenges that assumption. He questions whether institutions are truly more financially literate than individual investors. He expresses greater faith in collective intelligence and the wisdom of crowds than many would expect from a hedge fund manager. That perspective surprised me. Most institutional investors defend the existing system because it benefits them. Laffont seems willing to question whether ordinary investors deserve greater access to private markets. This directly connects to his belief that many of tomorrow's biggest winners are staying private longer. If companies like OpenAI, Anthropic, and SpaceX remain private while they create enormous value, then public investors may be excluded from some of the most important growth opportunities of the decade. As a result, Laffont discusses creating investment structures that provide broader access to both public and private assets. Of course, he acknowledges that there are restrictions and risks involved. Private investments are less liquid and often more complex, but he clearly believes the investing landscape is evolving. Toward the end of the interview, he returns to a theme that appears repeatedly throughout his comments: long-term thinking. Laffont emphasizes that identifying the future winners requires patient capital. If you're trying to predict what the world will look like 10 years from now, daily volatility becomes largely irrelevant. That idea is easy to say but incredibly difficult to practice. Every day investors are bombarded with headlines, earnings reports, political developments, market swings, and social media noise. Yet Laffont's approach is almost the exact opposite. He's trying to imagine what the future index of dominant companies will look like a decade from now. Who will control artificial intelligence? Who will dominate space? Who will redefine productivity? Who will become the next generation of global champions? Those are the questions driving his investment decisions. After listening to this interview, my biggest takeaway is that Philippe Laffont appears more excited about the future of artificial intelligence than almost any other opportunity in the market today. While he remains uncertain about Bitcoin's long-term role, he sounds remarkably confident that AI, agentic systems, and next-generation technology companies will reshape the global economy in ways most people still underestimate. Whether he's ultimately right or wrong remains to be seen, but one thing is clear: he isn't investing based on what worked over the last decade. He's investing based on what he believes will dominate the next one. And for investors looking to stay ahead of major trends, that mindset alone may be one of the most valuable lessons from this entire conversation. Now let's dive in and break down the 3 under-the-radar AI stocks that could have the potential to deliver outsized returns as artificial intelligence transforms the global economy. Let's start with the first stock, Grid Dynamics, ticker symbol GDYN. When most investors think about artificial intelligence, they immediately focus on chip makers, cloud providers, or the companies building the most advanced AI models. But there is another side of the AI revolution that often gets overlooked. Someone has to help large enterprises actually implement AI, and that is where Grid Dynamics comes into the picture. The reality is that many corporations understand AI is important. They know they need to modernize operations. They know automation can increase productivity. They know AI can reduce costs and improve customer experiences. The problem is execution. Deploying AI at scale across a large organization is far more difficult than simply buying software. It requires integration, customization, security, infrastructure, data management, and ongoing optimization. This is where Grid Dynamics has built its niche. The company specializes in helping large enterprises build and deploy AI-powered solutions. Rather than competing directly against the companies creating large language models, Grid Dynamics helps businesses put those technologies to work. In many ways, the company represents a picks and shovels approach to the AI boom. During every major technological revolution, some of the biggest winners are not necessarily the companies creating the technology itself. Often the winners are the businesses helping everyone else adopt it. That is one of the reasons Grid Dynamics is becoming increasingly interesting. The company recently launched its GDYN platform suite, a collection of agentic AI solutions designed to address multiple enterprise needs. These include commerce applications, software development automation, risk management systems, and even physical AI initiatives. Think about what that means. The AI conversation is rapidly shifting from simple chatbots toward intelligent agents capable of completing tasks, making decisions, and handling workflows with minimal human involvement. This is exactly the trend that billionaire investor Philippe Laffont recently discussed when he described a future where people effectively have thousands of AI workers operating on their behalf. Grid Dynamics is positioning itself directly in front of that trend. Instead of waiting for the future to arrive, the company is actively building the tools enterprises need right now. What makes this opportunity particularly interesting is the disconnect between the company's business performance and its stock performance. Shares currently trade around $7.13. Over the past year, the stock has fallen more than 45%. At first glance, that might sound alarming, but smart investors often pay attention when strong businesses become disconnected from market sentiment. The decline was largely driven by slower IT spending and cautious enterprise budgets. Many corporations temporarily paused technology projects while evaluating economic uncertainty. As a result, Grid Dynamics found itself caught in a broader slowdown that affected numerous technology consulting and implementation firms. However, when you look beneath the surface, the picture becomes far more compelling. During the first quarter of 2026, Grid Dynamics generated revenue of $104.1 million. Even more importantly, AI revenue accounted for 29.3% of total revenue. Think about that for a moment. Nearly 1/3 of the company's business is now directly tied to artificial intelligence. That is not a future promise. That is happening today. For full year 2025, AI revenue surpassed $90 million and grew 30% year over year. That growth rate matters because it demonstrates that customers are not simply experimenting with AI anymore. They are spending real money to implement these technologies throughout their organizations. And Grid Dynamics is becoming one of the companies helping make that transition possible. One of the biggest concerns investors should always evaluate is financial strength. A promising AI story means very little if the company lacks the resources to survive economic downturns or invest in future growth. Fortunately, Grid Dynamics appears to be in a strong position. The company carries essentially no debt and holds approximately $327.47 million in cash. That balance sheet strength provides flexibility. Management can continue investing in AI initiatives. The company can pursue growth opportunities. And perhaps most importantly, it reduces the financial risk that often accompanies smaller technology companies. This is one reason I find Grid Dynamics particularly interesting compared to many speculative AI names. A lot of smaller AI companies are constantly raising capital, issuing shares, or taking on debt to fund operations. Grid Dynamics does not appear to be facing that same pressure. The company already has a significant cash position and a healthier financial foundation. Another factor worth discussing is customer quality. Not all revenue is created equal. A company serving small businesses often faces very different challenges than one working with large global enterprises. Grid Dynamics has built relationships with major customers across multiple industries. Management has also worked to diversify the business away from heavy dependence on any single sector. That diversification is important because it helps reduce risk. When a company relies too heavily on one industry, a downturn in that sector can severely impact results. Grid Dynamics appears to be creating a broader customer base that can support long-term growth. Now let's talk valuation. This is where things become especially intriguing. Despite its growing AI exposure, strong balance sheet, and enterprise customer relationships, the company trades at roughly 1.4 times sales. For many investors, that multiple may seem surprisingly low given the current enthusiasm surrounding artificial intelligence. The market often rewards AI-focused companies with significantly higher valuations. Yet Grid Dynamics continues to trade like a small-cap value stock rather than a business participating in one of the largest technological transformations in decades. That discrepancy creates opportunity. The market is not always efficient in the short term. Sometimes investors become so focused on the biggest headlines that they overlook smaller companies quietly executing behind the scenes. Grid Dynamics may fit that description. Analyst sentiment also remains constructive. The stock currently carries 6 buy ratings and 0 sell ratings, with analysts maintaining an average price target around $9. That suggests meaningful upside potential from current levels if the company continues executing its strategy successfully. Of course, every investment comes with risks, and it is important to discuss them honestly. One concern is client concentration. Large enterprise customers can represent substantial portions of revenue. If a major customer reduces spending, delays projects, or shifts priorities, financial results could be affected. Another issue involves margins. Gross margin recently compressed to 34.8%. Margin pressure can limit profitability even when revenue continues growing. Investors should monitor whether management can maintain pricing power while expanding AI services. Competition also remains intense. The AI implementation market is attracting increasing attention from consulting firms, software providers, and technology service companies. Grid Dynamics must continue demonstrating that its expertise and platform offerings provide meaningful differentiation. Still, when I weigh the risks against the opportunity, I believe the investment case remains compelling. CEO Leonard Livschitz recently described 2026 as a pivotal year for the accelerated adoption of the company's AI offerings. That statement aligns with broader industry trends. We are moving from experimentation toward implementation. Businesses are no longer asking whether they should adopt AI. They are asking how quickly they can deploy it and what competitive advantages it can create. That shift could become a major catalyst for companies like Grid Dynamics. Personally, what I find most attractive about this stock is that it offers AI exposure without requiring investors to pay the extreme valuations often associated with headline-grabbing AI companies. Instead of betting on which AI model wins, Grid Dynamics allows investors to participate in the broader enterprise adoption trend, and that trend may last for years. As artificial intelligence becomes embedded across industries, organizations will continue needing partners capable of designing, deploying, and optimizing AI systems. Grid Dynamics is positioning itself to become one of those partners. The company may not receive the same attention as larger AI names. It may not dominate financial headlines, but sometimes the most rewarding investments are the ones investors discover before everyone else notices. That is exactly why Grid Dynamics deserves a closer look from anyone searching for under-the-radar AI opportunities today. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the second stock on our list, C3.ai, ticker symbol AI. Few companies have experienced a more dramatic journey during the artificial intelligence boom than C3.ai. At one point, the company became one of Wall Street's favorite AI stocks. Investors piled into the shares because the ticker symbol itself seemed perfectly positioned for the AI revolution. The excitement was enormous, expectations skyrocketed, and for a while, the stock became one of the market's most talked about artificial intelligence investments. But then reality arrived. Growth slowed, competition intensified, investors became less willing to pay premium valuations for companies that could not consistently deliver strong financial performance. As a result, the stock suffered a brutal decline. Today, shares trade around $9.29 and remain down more than 59% over the past year. For many investors, that kind of price collapse is a warning sign. For others, it may represent an opportunity. And that is exactly why C3.ai is one of the most fascinating turnaround stories in the AI sector right now. Before we discuss the numbers, let's talk about what the company actually does. C3.ai develops enterprise artificial intelligence software designed to help organizations deploy AI applications across complex environments. The company serves industries where precision, reliability, and security are critical. This includes federal agencies, defense organizations, aerospace customers, and large enterprises operating mission-critical systems. That customer base matters. While consumer AI products often generate headlines, some of the most valuable AI deployments are occurring behind the scenes in government agencies, military organizations, infrastructure systems, and industrial operations. These customers are not looking for entertaining chatbots. They are looking for tools that can analyze massive datasets, improve operational efficiency, strengthen security, detect anomalies, and support high-stakes decision-making. That is where C3.ai focuses its efforts. And that focus could ultimately become one of the company's biggest advantages. One trend I have been paying close attention to is the increasing role artificial intelligence is playing in national security and defense. Governments around the world are investing heavily in AI capabilities. The reason is simple. Artificial intelligence is becoming a strategic technology. Countries understand that AI can improve intelligence gathering, logistics, cybersecurity, surveillance, operational planning, and countless other mission-critical functions. Companies positioned to serve that demand could benefit from long-term spending trends that extend far beyond traditional economic cycles. This is one reason why C3.ai remains on many investors' radar, despite its recent challenges. Now let's address the elephant in the room. The company's recent financial performance has not been pretty. During the third quarter of fiscal year 2026, revenue declined 46.1% year-over-year to approximately $53.26 million. That result missed expectations and raised serious concerns among investors. A revenue decline of that magnitude is not something that can be ignored. Naturally, the market reacted negatively. Many shareholders lost confidence. Analysts questioned whether the company could successfully compete in an increasingly crowded AI landscape, and the stock continued to struggle. However, investing is often about looking forward rather than backward. Sometimes the most important question is not what happened last quarter. The more important question is what happens next. This is where the turnaround story begins. The company brought in a new CEO, Stephen Ahikian, who is now several months into a major restructuring effort. His mission is straightforward: reduce costs, improve execution, increase accountability, and position the company for long-term profitability. Management expects the restructuring to generate roughly $135 million in annual operating expense savings. That is a significant number relative to the size of the company. Part of this effort includes reducing the workforce by approximately 26%. Layoffs are never pleasant, but from an investor's perspective, cost discipline can be essential when a company is trying to restore profitability and strengthen operations. What makes this story particularly interesting is that while certain areas of the business have struggled, other segments are showing impressive momentum. Federal, defense, and aerospace bookings increased 134% year-over-year. Let that sink in. 134% growth. That is not incremental improvement, that is explosive growth. Even more importantly, these segments now account for approximately 55% of total bookings. This suggests the company's strategic focus may be shifting toward areas where demand remains strong and where competition may be less intense than in broader enterprise software markets. I think this trend deserves far more attention than it currently receives. Investors often focus on headline revenue numbers while overlooking the quality and composition of future business. Bookings provide insight into future demand, and right now demand from federal and defense customers appears to be strengthening significantly. Another positive development involves the company's revenue mix. Subscription revenue now represents approximately 90% of total revenue. That matters because recurring subscription revenue tends to be more predictable and more valuable than one-time sales. Companies with strong subscription businesses often enjoy greater visibility into future cash flows. Over time, that can support higher valuations if growth returns. CEO Stephen Ehikin has stated that C3.ai is uniquely positioned to win in enterprise AI and has emphasized building a more agile, disciplined, and accountable organization. Whether management can successfully execute remains to be seen, but at least there is now a clear strategic roadmap, and that is something investors desperately wanted to see. Now let's discuss why this stock could potentially offer significant upside. The market often overreacts to both good news and bad news. When growth stocks disappoint, investors frequently abandon them completely. The result is that expectations become extremely low. Ironically, that is sometimes where the best opportunities emerge. When expectations are low, companies do not need perfection to drive share price appreciation, they simply need improvement. And if C3.ai can stabilize revenue, continue expanding federal bookings, and successfully implement cost reductions, the stock could begin attracting investor interest again. That does not mean success is guaranteed. Far from it. In fact, the risks here are substantial. One of the biggest concerns is cash burn. The company recently generated negative free cash flow of approximately $56.2 million. That means more cash is leaving the business than coming in. While restructuring efforts may improve the situation, investors should continue monitoring cash flow carefully. Another concern is profitability. Gross margin compressed to approximately 17%. For a software company, that is not where investors would like to see margins. Improving profitability will be critical if management hopes to restore confidence. There is also a pending securities class action lawsuit involving the company. Legal uncertainties can create additional risks and distractions for management. Investors should be aware of that reality before considering any position. So why discuss the stock at all? Because investing is ultimately about balancing risk and reward. And at current levels, the market appears to be pricing in a significant amount of pessimism. Sometimes stocks deserve that pessimism. Other times the market becomes excessively negative and creates opportunities for patient investors willing to tolerate uncertainty. What I find most compelling about C3.ai is not necessarily what the company is today. It is what the company could become if management successfully executes its turnaround plan. Imagine a scenario where defense and federal bookings continue growing rapidly. Imagine cost reductions improve profitability. Imagine recurring subscription revenue continues expanding. Imagine the company reestablishes itself as a credible enterprise AI platform provider. Under that scenario, today's valuation could look very different several years from now. Of course, there is also a scenario where execution falls short and the turnaround fails. That is why I would classify C3.ai as an aggressive investment rather than a conservative one. This is not the type of stock investors buy expecting smooth, predictable returns. This is the type of stock investors buy because they believe the market may be underestimating the probability of a successful recovery, and if that recovery occurs, the upside could be substantial. Personally, I think the defense and government angle is what makes this story worth watching. Artificial intelligence is becoming increasingly important to national security. Organizations operating in those sectors often prioritize reliability, security, and long-term partnerships over flashy consumer features. If C3.ai can establish itself as a trusted AI provider within those ecosystems, the company could benefit from powerful long-term tailwinds. That possibility alone makes the stock difficult to ignore. The question investors must ask themselves is simple. Do they believe management can execute the turnaround? If the answer is yes, C3.ai may represent one of the more intriguing recovery opportunities in the AI sector today. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to the third and final stock on our list, BigBear.ai, ticker symbol BBAI. If Grid Dynamics represents AI implementation and C3.ai represents enterprise software and government AI applications, then BigBear.ai sits in one of the most strategically important areas of artificial intelligence today: decision intelligence. This is a segment of AI that does not always receive the same attention as chatbots or image generators, but it may ultimately prove just as important. Decision intelligence focuses on helping organizations process massive amounts of information, identify patterns, anticipate outcomes, and make better decisions faster. For national security agencies, defense organizations, border operations, logistics providers, and government institutions, that capability can be incredibly valuable. The ability to make faster and more informed decisions can influence everything from resource allocation to operational planning to threat detection. That is exactly where BigBear.ai has concentrated its efforts. The company develops AI-powered decision intelligence solutions designed primarily for government and defense-related customers. And in a world where geopolitical tensions continue rising and governments increasingly prioritize technological superiority, that positioning could create meaningful opportunities over the long term. One thing I find particularly interesting about BigBear.ai is that it operates in a niche where barriers to entry can be higher than many investors realize. Winning government contracts is not easy, building relationships with federal agencies is not easy, meeting security requirements is not easy, and maintaining those relationships over many years requires significant expertise and trust. These factors can create competitive advantages that are often overlooked by the market. Now let's talk about what has changed recently, because this is where the story becomes much more compelling. Over the past year, BigBear.ai has undergone a dramatic financial transformation. The company ended 2025 with approximately $462 million in cash and investments. That is a remarkable figure for a company of its size. The strengthened balance sheet came after the company raised approximately $693 million and reduced debt by more than 90%. That last point deserves emphasis. Reducing debt by over 90% fundamentally changes the risk profile of a business. Companies burdened by excessive debt often spend more time worrying about survival than growth. By dramatically improving its balance sheet, BigBear.ai has given itself more flexibility to pursue opportunities and invest in expansion. In fact, CEO Kevin McAleenan described the company as being in the strongest financial position in its history. That is a bold statement, and when evaluating smaller AI companies, balance sheet strength can be one of the most important factors investors consider. Many speculative technology companies struggle because they run out of capital before their business models fully mature. BigBear.ai's cash position helps reduce that concern. But the balance sheet is only part of the story. The company's acquisition strategy is also worth examining. One of its most important recent moves was the acquisition of Ask Sage. This acquisition adds a generative AI platform that already serves more than 100,000 users across roughly 16,000 government teams. Think about that scale: 100,000 users operating within government environments. That is not a small pilot program. That is meaningful adoption, and it gives BigBear.ai direct exposure to one of the fastest-growing areas within artificial intelligence. Generative AI is rapidly becoming integrated into workflows across both private and public sectors. Organizations are looking for secure environments where employees can use AI tools while maintaining compliance and protecting sensitive information. Ask Sage appears well-positioned to address those needs within government ecosystems. This acquisition could become a major growth driver over the coming years. The company also strengthened its capabilities through the acquisition of CargoSeer, further expanding its operational intelligence offerings. Taken together, these acquisitions suggest management is actively building a broader AI platform rather than relying on a single product line. That diversification could become increasingly important as customer needs evolve. Now let's discuss revenue expectations. Management has guided fiscal year 2026 revenue to a range between $135 million and $165 million. While that may not sound enormous compared to larger technology companies, investors need to remember that BigBear.ai remains a relatively small business. What matters most is whether revenue can grow consistently while the company expands margins and strengthens customer relationships. Another encouraging metric is backlog. BigBear.ai currently reports a backlog exceeding $400 million. A backlog essentially represents future work that has already been contracted but has not yet been recognized as revenue. For investors, backlog can provide valuable visibility into future business activity. When a company has a large backlog relative to its size, it often suggests customers continue placing orders and management has opportunities to convert those contracts into future revenue. That does not guarantee success, but it does provide evidence that demand remains present. Now let's discuss why the stock remains speculative despite these positives. Shares currently trade around $4.18. The stock has experienced significant volatility over the past year, and there are legitimate reasons for investor caution. One concern involves recent financial performance. During the fourth quarter of 2025, revenue declined 38% year-over-year. That is a substantial decline. Anytime revenue falls by that magnitude, investors should ask questions. Was it temporary? Was it contract timing? Was it execution related? Or does it signal a deeper issue? Management believes the company remains positioned for future growth, but investors should continue monitoring results closely. Another concern is profitability. Gross margin recently compressed to approximately 20.3%. As we discussed earlier with C3.ai, margin pressure can create challenges even when a company's long-term opportunity remains attractive. Improving operational efficiency will be critical moving forward. The company has also disclosed material weaknesses in internal controls. That is not something investors should ignore. Strong internal controls are essential for maintaining confidence in financial reporting and operational oversight. Management will need to demonstrate progress in addressing those weaknesses. Then there is the issue of volatility. BigBear.ai carries a beta above 3. For those unfamiliar with beta, it is a measure of how volatile a stock tends to be relative to the broader market. A beta above 3 suggests that the stock can experience very large price swings. That means investors should expect volatility. This is not a stock for someone who checks their portfolio every day and becomes nervous whenever shares move sharply. Patience and risk tolerance are essential. Despite these risks, I think the broader investment thesis remains intriguing. The defense AI market appears poised for long-term growth. Governments are increasingly incorporating artificial intelligence into national security initiatives. Military organizations are adopting AI tools for planning, logistics, intelligence analysis, and operational efficiency. Border security operations are becoming more technology-driven, and public sector demand for secure AI platforms continues increasing. These trends are not likely to disappear next year. They could persist for decades. BigBear.ai has positioned itself directly within that ecosystem. That alone makes the company worth watching. What I find especially attractive is the combination of a stronger balance sheet, a sizable backlog, and exposure to government-focused generative AI applications. Those factors provide multiple paths to potential growth. At the same time, investors must remain realistic. This is still a speculative investment. Execution risk remains significant. Financial results must improve. Margins need to stabilize. And management must continue proving that recent acquisitions will generate meaningful returns. For conservative investors, BigBear.ai may simply belong on a watch list. For aggressive investors comfortable with volatility, it may represent an interesting way to gain exposure to defense-focused artificial intelligence. Ultimately, investing often comes down to identifying opportunities before they become obvious to everyone else. The biggest winners are rarely discovered after they dominate headlines. They are often found during periods when uncertainty remains high and market attention is limited. BigBear.ai may or may not become a major winner, but it certainly possesses characteristics that make it worth studying carefully. Now let's quickly recap the 3 under-the-radar AI stocks we covered today. Grid Dynamics offers investors exposure to enterprise AI implementation and agentic AI adoption, supported by a strong balance sheet, growing AI revenue, and a valuation that remains surprisingly reasonable. C3.ai represents a turnaround opportunity with growing momentum in federal, defense, and aerospace markets, though investors must weigh that opportunity against significant execution risks. And BigBear.ai provides exposure to decision intelligence, government AI adoption, and defense technology trends, backed by a dramatically improved balance sheet and a growing platform strategy. Each company operates in a different corner of the AI ecosystem. And that is important because the artificial intelligence revolution will likely create multiple winners across multiple industries. Not every successful AI investment will be a chipmaker. Not every winner will be a cloud company. Some of the biggest opportunities may emerge from businesses quietly helping organizations implement, secure, and operationalize AI at scale. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these 3 AI stocks do you believe has the strongest long-term competitive advantage? Grid Dynamics, C3.ai, or BigBear.ai? And which one would you be most comfortable holding for the next 5 to 10 years? Let me know in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.